Welcome to The Explainer. Today, we're looking at a machine that literally spans the globe. A system so vast and so intricately connected that it actually dictates the pace of human progress, industry, and wealth. At its core, it's a marketplace. But, it's not dealing in fruit or textiles. It deals in human ingenuity, corporate ownership, and the collective belief in tomorrow. We're talking, of course, about the global stock market. Just to wrap our heads around the sheer gravity of what we're talking about, I want you to anchor yourself to this number, $111 trillion, right? Let that sink in. By the end of 2023, that was the total market capitalization of all publicly traded stocks worldwide. It's an almost incomprehensible amount of money. It represents the combined value of ownership in companies across the entire planet. This colossal aggregation of buyers and sellers has completely transformed from a simple concept of shared debt into the absolute literal cornerstone of our modern financial system. Section 1. Origins of the exchange. Let's look at a brief history. Okay, let's dive right into this. Why was this market created in the first place? It didn't start out with algorithms or massive glass skyscrapers. It actually started with a really basic human need to manage risk and finance trade. Our timeline begins way back in 12th century France. Here, agricultural communities needed to manage their debts with banks, right? And the men who regulated these debts, they were called the courtiers de change. They essentially became the world's very first brokers. Fast forward a bit to the late 13th century in Bruges, and commodity traders started gathering outdoors at this local inn owned by the Van der Beurs family. This regular meeting became known as the Bruksbeurs. And fun fact, the family's name is actually where the word bourse, which we still use today for a stock exchange, comes from. As we move into the 14th century, the whole system gets a lot more complex. By the mid-13th century, Venetian bankers had started trading in government securities. And get this, by 1351, the Venetian government actually had to pass laws outlawing the spread of rumors that were intended to lower the price of those funds. So yeah, market manipulation is pretty much as old as the market itself. But the true leap toward the modern market we know today, that happened in the early 1600s with companies like the Dutch East India Company. In 1606, in Enkhuizen, we see one of the oldest known joint stock certificates ever issued. This was a total game changer. It allowed multiple shareholders to jointly own a company, effectively spreading out the massive financial risks of funding those early colonial expeditions to the New World. Section 2. Mechanics of the market. Let's break down exactly how it works. So we know it's absolutely massive, and we know it's incredibly old. But how does the machinery actually work? Well, this brilliantly illustrates the foundation of the entire system. The market is actually split into two very distinct phases of negotiation. First up, you have the primary market. This is where financial assets are literally created. In this phase, a business transmits its shares directly to investors. Why? To raise capital for expansion. They need cash to grow. But once those shares are issued, they move over to the secondary market. And this is the market you hear about on the news every single day. At this point, the company itself is no longer directly involved. Instead, investors are simply exchanging those previously issued, already existing financial assets among themselves. Now, to make that secondary market function smoothly, without total chaos, you need three absolute essentials. First, you have bids and asks. Simply put, a buyer bids a specific price they're willing to pay, and a seller asks for a specific price they're willing to accept. When those two numbers match, boom, a trade happens. This constant, ongoing matching process is what we call price discovery. The second essential is liquidity. Because you literally have millions of people trading, you can quickly and easily sell your shares. This makes stocks incredibly attractive when you compare them to immovable assets like real estate, which, can take months or even years to offload. And finally, the third piece of the puzzle, clearinghouses. When you buy a stock, the exchange actually acts as a guarantor. They collect and deliver the shares, and they guarantee the payment to the seller. This is absolutely crucial because it entirely eliminates the risk that the person on the exact other end of your trade might just default. Moving on to Section 3, who owns the market? Let's look at the demographics. So the mechanics are highly structured to facilitate growth for sure. But who exactly is participating in all of this? Let's take an objective, purely data-driven look at the demographics of the people and the institutions who actually own this ecosystem. Market participation generally falls into two buckets, direct and indirect investment. Direct investment is pretty straightforward. It means you personally go out and buy shares of a specific company. Indirect investment, on the other hand, means you own shares through a vehicle, like a mutual fund or a retirement account, something like a 401k or a pension. Historically speaking, indirect participation has grown at a much faster rate, and economists attribute this differential growth directly to the tax code. In places like the United States, indirect investments in pension funds and 401ks are heavily incentivized. That's because they're taxed only when the funds are actually withdrawn. But money used to directly purchase stock, that's subject to immediate taxation, and so are any dividends that those stocks generate. Now, what's really interesting about this next piece of data is how that ownership is actually distributed across different wealth strata. Looking at the numbers as of 2025, there is a pretty stark disparity. The top 10% of Americans own 87.2% of the stock market. Meanwhile, the middle 40% hold about 11.7%, and the bottom 50% of the population, they own just 1.1% of the market. So why is it skewed this way? Well, behavioral economists and researchers point to things like fixed costs, education levels, and access to information as the primary barriers that keep nearly half of all households from participating in the market. And we see significant statistical differences across racial demographics as well. If we look specifically at direct market participation, the data shows that households headed by white individuals participate at a rate of 24.5%. This compares to 6.4% for Black households and 4.3% for Hispanic households. And we actually see similar patterns existing in indirect participation too. It really just highlights that market access and overall ownership are definitely not uniformly distributed across the broader population. Section 4. Crashes, Panics, and Psychology. So, the crucial point we have to remember is that behind all of this cold, hard data, the stock market is entirely driven by humans. And let's be honest, humans are not always perfectly rational. Let's move away from the numbers for a second and step into the incredibly volatile world of human behavior, market panics, and crashes. Now, in financial economics, there's this core idea. It's called the efficient market hypothesis, or EMH. It states that asset prices perfectly reflect all available information at the current time. Essentially, it assumes that markets behave rationally and that non-rational reactions to news simply cancel each other out. Makes sense on paper, right? But this hypothesis really struggles to explain the actual reality of things like irrational exuberance, mass panic, and sudden, wild price movements that just seem to happen without any new fundamental information being released. Actually, this quote beautifully captures the psychological reality of what's going on. In normal, quiet times, the market behaves a bit like a game of roulette, right? The probabilities are known, and your bets are totally independent of what the other players at the table are doing. But in times of market stress, however, the game becomes more like poker. Players now must give heavy weight to the psychology of other investors. Groupthink just completely takes over. People are naturally predisposed to seeing patterns in mere noise, and that leads to huge overreactions. Herd mentality kicks in, and suddenly, prices can deviate wildly from their actual fundamental economic value. And when that psychology breaks down entirely, well, that's when we get crashes. A crash is essentially a sharp, sudden dip in share prices, usually driven by the investing public's total loss of confidence. Take 1929, for example. Black Thursday kicked off a devastating 50% loss in the Dow and effectively ushered in the Great Depression. Then, jumping to 2007 to 2009, the subprime lending crisis triggered the Great Recession, wiping out a staggering 57% of the S&P 500's value. In 2020, the sudden outbreak of a global pandemic caused an immediate, massive market contraction. But, perhaps the most fascinating psychological event of them all was Black Monday, back in 1987. The Dow dropped an astonishing 22.6% in a single day. And honestly, the most shocking part? An exhaustive search by economists failed to detect any generally agreed-upon reasonable cause or new information that could account for the crash. There was no catalyst. It was just pure, unadulterated market panic spreading like wildfire. Section 5. The modern electronic ecosystem. Let's look at today's boundaries. Let's see how all of this builds into the highly structured system we use today. Following these massive psychological events, financial regulators basically realized that human emotion desperately needed some automated boundaries. The market had to evolve from, humans physically shouting at each other on trading floors to high-speed, strictly regulated electronic networks. To combat uncontrollable panic, exchanges like the New York Stock Exchange introduced this really clever concept of the circuit breaker. Notice the thresholds here. If the market drops by 7%, it halts all trading for 15 minutes. A 13% drop, that triggers another 15-minute halt. And if the market drops by a whopping 20%, trading is entirely stopped for the rest of the day, period. It's essentially an electronic cooling-off period, designed specifically to force human beings to just stop, take a breath, and break that dangerous cycle of herd panic. Today, the vast majority of trading is done via these electronic matching engines. They're accessible to absolutely anyone with a smartphone, but they are heavily guarded by these strict mathematical safeguards. Which brings us to the ultimate question, doesn't it? We've seen the market's origins in 12th century agricultural debt. We've seen how it expertly raises capital for the world's largest companies, and we've explored how the wealth it generates is actually distributed. But when you look at those algorithmic circuit breakers, the ones built specifically to stop us from panicking, you really have to ask yourself, is the stock market a cold, rational reflection of true economic value, or is it simply the world's largest, most complex mirror of human psychology? Honestly, it's likely a fascinating blend of both. Thank you so much for joining me on this explainer, and keep questioning the systems that shape our world.